welcome back. Hope everybody had a great Turkey Day.
Yes, it was good. Still shaking it off. Fantastic holiday.
Keeping the pounds heading down, right?
Got to try and save some room so they can stack back up over Christmas. Yep. It's just like rates. We have some good days. We have some bad days. We have some good days. We have some bad days.
We have some good holidays, and that's one of the best ones for sure. All right, let's get into this. This is going to be a fun one, or let's try to keep it fun. We're going to
your favorite topic.
We're going to myth bust this whole down payment assistance. I have zero money, but I'm going to get down payment assistance. What's the first thing you think of when you hear this?
It's just a recipe for disaster. How's that?
Okay, that's good.
No, I mean, the first thing that comes to my mind is the concept, I believe, when it was started, may have had some legs. And I believe that the real estate community artificially props that up as a way to get people enticed or excited to buy a home. And so I don't think there's anything wrong with those two things. It's just when you get to reality, it's just not good.
All right. So getting somebody interested in home ownership and getting their wheels started, having them do a little bit of homework, research, get into the budgets. That's the pro of it.
Yes. I think it ends right there.
All right. Okay. All right. So first, let's give a little background. Down payment assistance is done on an FHA or 3.5% down mortgage. So
that's where most of it comes in. Depending on what part of the country you're in, that could apply to the conventional financing as well. But yes, it's primarily associated with the FHA loans.
All right. So where do you get this information? Who does it? There's a myriad of different spots you can go. So you have some nonprofits that do it. You have specific banks that will do it. And it could be a state funded program.
County, state. Yep.
You're reaching out to these places and you're saying, hey, that 3.5%, I don't have it. Can you hook me up with the 3.5% so I can buy that house and get in at a relatively low cost of entry because I don't have a lot of funds?
Correct.
Okay. So first-time home buyers are using this, or they're looking for it, and they believe that they can get some kind of free, basically government cheese, we'll call it. And they don't know how it works. They don't know how they have to pay it back, if they have to pay it back, who they go to get it, how it all works. These are the most inexperienced home buyers out there. So nothing can go wrong with this program, right?
Yeah, you're least experienced, have not illustrated an ability to save, buying a home with no skin in the game. All of those things lead to default ratings on that type of a loan structure being far, far greater than any other type of a loan.
All right.
If we go back to the mid 2000s, when we'll call them liar loans or stated income loans, there were opportunities where people could buy a primary residence or an investment property, just say what their income is, not document it, no cash involved, and acquire real estate. And that's when things went bad, because there's no financial stability to weather any kind of a slight, just a minor hiccup in a budget. All of a sudden the loan's in jeopardy.
So with these loans, being it's their first time, they typically don't have credit scores that are established or, above the 720, 740, 760 threshold. They have lower all credit scores. They have lower reserves. They have less time on their job. And now we're going to get into the spot. Before we go into the exact details of the program, let's tell everybody why it doesn't work in this environment, hasn't worked in the past 18 months. We don't expect it to work at a high rate in the next 12 to 18 months. Why is that?
All right, this may be long-winded, so hang in there, right? If you're a seller and you're entertaining a buyer that wants to purchase your property, and in the last 18 months, if you're a seller, you've not only had one person that's expressed interest in buying your property, but you may have a number of people that are interested. So if I'm a seller, I'm going to go, okay, how many of those are cash buyers? They're at the top of the list. How many of those have conventional financing with a large down payment? They're going second on the list. Then I'm going, okay, how many of those are conventional buyers with maybe 5 or 10% down? I put those, again, we're going from top to bottom. If I'm looking at those offers, FHA carries a stigma that loan means there's more red tape associated with it, or the person purchasing the home has some issues that may convey some risk to the seller. So we'll throw that there. That's about at number 5. If it's an FHA loan with more than a 3.5% down payment, that's going to move up on the list. But the stuff we're talking about is an FHA buyer with down payment assistance. That takes your offer, and however many there are, it automatically puts you at the bottom of the list. So if there's one other person of interest, your odds of succeeding are very, very slim.
I hope everybody can pick up that part of it. Let's talk in terms of where we have 18% appreciation last year. Industry analysts are saying anywhere from 5 to another 15% in this next year. We're close to peaking out, we believe. It could be April, it could be July, it could be September of next year. At some point, we're going to reach the top of the mountain and we're going to come back down in terms of the values of the properties. So if you're putting 0% down now and we lose 10 or 15 or 20% of the value of your property, it's a big problem.
It is. Your ability to repay is one thing, but then your willingness to pay may factor into that as well. When the housing crisis took place back in, call it 06 to 09, there were people that didn't have the ability to make payments and loans went bad. And then there were people that had the ability because they weren't so excited about their equity position, decided they didn't want to make payments. So you're absolutely correct. It's one thing about being excited of home ownership when that happens. And then the other thing is, are you actually going to be able to make those payments? Or understand that you're now locked into that property, your mobility has been removed.
All right, we'll touch on that a little bit here towards the end. Let's talk about this assistance. So let's use a $200,000 mortgage. 3.5% down on that is $7,000 as your down payment. So this $7,000, there's 4 different ways that you can basically, does it have to be paid back? That's what people want to know. So there's a unicorn program out there that's a grant that doesn't have to be paid back. Throw that out of the mix. The chances of you qualifying for that and getting that is slim to nil. Then the other 3 are second mortgages. One you pay monthly, one you get forgiveness on the loan over a period of time, and then one that is never forgiven, but it's paid when you sell or you refinance the note, the first mortgage note. So basically in 99% of the time, you're going to have to pay that second mortgage back. No free lunch. Okay, is it more expensive to go this route? Talk to me about that.
Yeah, when we look at that, your ability to shop your home loan if you have a down payment compared to shopping your home loan when you need that assistance, there's anywhere from 3/8 to 0.5% difference in interest rate that you're going to pay on the primary mortgage. So in your example, the $200,000 purchase price, we'll call it a $7,500 down payment. So on 192,000 and some change, you're going to be paying 3/8 to 0.5% more in interest rate to have that luxury of not saving the money and coming up with your own down payment.
It could be more.
Could be.
Yeah, it could be 1%. It depends on the program.
It
Again,
depends.
there's so many of them out there. You're trying to give a best case scenario.
I am. And every time I've looked at it, it's been at least that much of a difference. And, so again, people look at this and go, man, this is great. And you're like, stop. I wouldn't say it's great. It's more about, let's look and make sure that it's not bad for you and understand that difference. We talk about this sometimes of the, all right, is this a Band-Aid we're putting on a bigger cause, which is what's going on in your world that you've not been able to save money? What's going on in your world that now all of a sudden I'm going from, I'm struggling to save a couple bucks, I'm carrying balances on credit cards, and you go from that scenario to home ownership is going to fix all my problems. And home ownership is fantastic over a period of time to increase your net worth. But man, there's some fundamentals, the old conversation with your dad or your uncle of, hey man, make sure you can save a couple bucks before you get into this. Because even if your payment is the same, you now have additional expenses of home ownership that you got to make sure that you can handle that.
Okay, so that second, we'll call it a second mortgage for the down payment assistance or the down payment loan per se. So the interest rate on your first mortgage is higher than if you weren't using down payment assistance. You have interest typically accruing at some rate on the second mortgage. The closing costs to facilitate this program are higher than if you weren't using down payment assistance. So it costs you more per month and it costs you more upfront, which again is eating into in this example, it's $77,000 for your down payment. It could be anywhere from $1,000 to $2,000 to $3,000 more in fees to do this loan. So that eats that up as well the other way. Does it take longer to get this loan through the system?
Yes, it does. How much longer? It could be 2 to 3 days. It could be 2 to 3 weeks.
Why does it take longer?
Well, because you have a borrower that the credentials are not as strong as somebody that saved up the money for the down payment. You also have a second level of review. So the lender has to approve it. And then wherever that secondary source of funds is coming from, they have to have some review and sign off on it. So the lender does their job, goes to the next spot, then that's another 1 to 3 to 5 days before that takes place. So in the grand scheme of things, hey, may not be that big of a deal in the difference in time, but every time we've seen it, those extra couple days, it's a nightmare.
So the seller will know this on the pre-approval letters that are written for these types of programs. It's required to disclose that they're using down payment assistance. And again, as Ken said up front, it's going to drop your offer down to the lowest in the barrel in terms of what it is they want to accept. There's typically income caps. You can't make too much money to qualify for the loan. There's location restrictions, different areas of the country. The program often runs out of money or funding at some point throughout the year.
Yep, qualifications are more stringent. Just logically speaking, in the underwriting or the mortgage world, if you have a large down payment, they're willing to stretch your qualifications. If you don't have a down payment, then your debt to income ratios are what they'll allow you to stretch. That gets constricted as well.
Okay, so you had mentioned maybe 3 minutes ago about it restricts your ability in the future to continue to grow your net worth. You're handcuffed between your first mortgage and your second mortgage, and having no equity. It's tough for you to take advantage of something that might be out there in the market where you could lower your overall cost of borrowing funds.
Absolutely. You know, we just went through an 18-month period of time where almost everybody in the entire world refinanced their home loan. And we came across a couple of these scenarios where people had purchased recently, values had gone up, but that not enough to combine the two loans, and a subordination process of getting that second mortgage that they had for the down payment to get the lender to allow the first mortgage to be refinanced was incredibly cumbersome and squashed their ability to refinance to get a lower rate. And I think what we're talking about, again, that this, hey, why wouldn't you go in with zero down? Or why wouldn't you take advantage of these programs? And what we're trying to just shed some light on is there's never a free lunch. There's always some restrictions. And just in today's marketplace, man, having the ability to get one of those offers accepted, it maybe 0.5%, maybe.
Okay, so typically what's going to happen is you're going to do a little bit of research. You're going to make some phone calls. You're going to get to somebody that says they will facilitate this. And it's like going to the store and buying the toaster oven. I want 2 slices, 4 slices, 8 slices. I want light, medium, dark, extra dark. And you fill out these forms, check these boxes. You're going to be pre-approved for that loan.
Totally.
What they're not going to do is what we're talking about right now is what is in your best interest. Because if we're talking $7,000 for a down payment, that can be, you can use gift funds from a family member, you can borrow from a retirement account, or basically loan yourself the money. These 2 examples are much more appealing in order for you to get your offer accepted, in order for you to be in a better position in 2 to 4 to 6 years down the road. That's what we want to talk about. So we want to talk to you like a wealth advisor, as opposed to go out and fill out this form and everything should be okay, and you're out there floating in the blind with no guidance.
Gosh, if you go back to the toaster, it's like, you know, you're at Target and they've got all those options, and the person at Target says, oh my God, the 8-slice toaster is on sale. And you go, great. But they don't know that you've lived in an apartment all by yourself, and you're going to end up spending more money on an 8-slice toaster when you only need a 2-slice toaster for the next 4 to 6 years. And it makes more. So that's the part that drives us crazy, that advisor component. Or, hey, yes, they're out there, but what really makes sense for you?
You have to spend the time, Mr. or Mrs. Consumer. You have to spend time with an advisor to help you get through this.
Mr. or Mrs. Real Estate Agent, you need to spend time with your customer to find out if that truly is needed.
Absolutely. Questions, comments, feedback, please leave it in the messages below. We'll get back to you when we can. We do not do down payment assistance programs. We won't do them. We don't believe it's in your long-term benefit or well-being to get into a situation like this. So we will help you and spend the time with you to say, hey, this is how you can save the money, or this is where you could get the money from, or this is what you're actually talking about and how you can get your offer accepted. This way is not going to work for 12 or 18 months, already hasn't worked for 12 or 18 months. We'll let you know when there comes a time.
Yeah, that's what we've talked about that too. When it does become an option that you can succeed, now you're going to be in that landlocked period where property values may stabilize. So the
Yep.
ability to get an offer accepted with that program means you have not one other person that has interest in that home. And that's when sellers will go back to negotiating. They'll ask a price, they'll settle for, and that's the new norm. That's the reason why another reason why we just don't believe it's the best option.
Guys, thank you for tuning in. Thank you for all the support. Ken, great job today.
Ditto, brother.
All right,
Peace.
thanks. Bye.